All right. It's episode 40 of the REI 101 podcast. Alberto, how are you doing, brother?
I am doing well. Got some bad news on a deal, which I'll talk about to you offline, but I'm doing pretty good. I'm doing pretty good.
I hope it doesn't affect me. It
It
sounds like
does
it
not
does.
affect. No, it doesn't affect you.
Hey,
But
bad news.
I don't want to give everyone my sad story, so we'll
Um,
keep it relevant here.
hey, man, if it's not for the defeats and failures, the victory doesn't taste as sweet.
That's right, buddy.
So yeah. The question is did you learn something?
Uh, well, it's a lesson I've already learned. So sure, sure, just learn it again.
Well, how was your weekend other than the deal falling through?
No, the deal didn't fall through. It's just funding. We've got
Hmm.
to work a little bit harder on funding. The deal's still there though, so that's still going forward. But the weekend was good. Man, enjoyed this beautiful weather over the weekend. It was cold, but it was
Yeah.
nice. And I'm ready for the week, man. I'm ready for this new month. I'm really excited about it.
Hey, it's the New Year's Day of the month today, the first work day of the new month. It's going by. So we got 11 of these left. So are you on track for your goals? I'm putting an offer in on a house today. So
Okay,
should be a pretty good deal. We have Andry Tetuyev. Am I saying your name
That's
good
correct.
enough?
You said it's close enough.
We got really, this is probably so far number 40 out of all 40 episodes. This is the number one most important episode because what we're going to talk about can be the difference between making money and not making money because, Uncle Sam has to get his first. So, but there are laws, there are rules that if you know the game, um, you can really take advantage of some tax advantages. So Andre's going to appear before us, with us, joining us. Andre, thank you for being here on REI 101, episode 40. How are you today, sir?
I'm doing great. Thank you guys for inviting me. I appreciate it. I'd love to definitely spend a little time. It's a fun topic. Taxes are an important piece of real estate investing, and they do frame the deal and could add a lot of benefit to it. So I'd love to share some practical examples and some things to consider for young investors, for seasoned investors, whoever's listening.
Now, everybody who's on the call, or if you're watching on YouTube, Andre, he's not just a tax specialist, but you were first real estate investor, and you still are. Why don't you tell us a little bit about your background in real estate investing first, and then we'll go into how you transitioned into the exciting world of taxes.
That's right. Well, that's a long journey, but yeah, you're right. I started kind of buying real estate a little bit at a time, learning along the way. My background is actually in banking. That's where I started my kind of real estate education, so to speak. I worked with a lot of real estate investors over the years. I was a commercial lender for 17 years,
Mm,
worked with local banks, putting these deals together, financing different developments and shopping centers and residential properties. So I've seen a lot of deals kind of come and go, and I was always on the sidelines watching people build wealth over time. And so that's what really kind of piqued my interest. And I started to participate myself with the knowledge that I got from observing successful investors work their deals. So that was my beginning. And over the years, I've expanded into different types of properties. Currently, I hold a good variety of different classes: shopping center, mobile home park,
nice.
residential. So I've done building homes for sale. So I've kind of dabbled in all parts of it. Definitely enjoyed taking advantage again the tax strategies there. And so after 17 years of banking, it was time for a career change. It was time to start something different. And in the background, as I was continuing my banking, I started to study tax and got my CPA license. And 6 years now, I've been in kind of business on my own, just running my CPA firm and developing real estate and investing in real estate. That's been my background in the last 2 decades.
I love that you're doing different asset classes. So I hear you in retail, mobile home, RV parks. Are there different tax advantage to different asset types that you find are um, we're hearing a lot of people asking about affordability, opportunity zones. Um, are you seeing some difference in advantages between those types?
I would say most of the difference I see in the scalability and just kind of the involvement, passive versus active. I think commercial, larger projects more easier to hand off to a manager.
Hmm.
So you really run it in a much more passive way. So that's a huge advantage of commercial in my experience. Residential, kind of small scale, takes a lot of work to build a big portfolio, very capital intensive. So it's their advantages. Of course, mobile home parks is a little bit different game. It's more leasing land only. That's kind of
Hmm.
like the strategy you take. So it's much easier to maintain. All the responsibility goes on the mobile home owners. So I've kind of enjoyed all of it, but commercial has been my favorite in some ways, but residential is so liquid. It's easier to pivot if you need to change something. It's easier to use leverage and get additional cash in these properties. So it has a purpose
Hmm.
for a sophisticated investor to consider all of them, kind of like how they fit the personality, the scale, the vision for the future, and they all
Yeah.
come together.
Yeah. It's good. Albert, did you have something?
No, I just wanted to make sure we get our disclaimer in that this is
Yeah.
educational purposes, right? This isn't considered tax advice. If you would like tax advice, hire a tax professional. I know Andre is available to be hired for his services, and he does a wonderful job. So I just want to make sure we get that out there.
And we definitely want to give you an opportunity before the end of the show to share who you are and how people can get in contact with you because as a investor and more so as a real estate broker on the commercial and the residential side, this is a topic that for some reason a lot of people tend to ignore or not give as much attention to as they should. Do you have any opinions why most people are ignoring the tax implications? And it's not just they're not taking advantage of the advantages. They're just ignoring some of the basics that end up biting them in the butt in the end, right?
Yeah, it's hard to tell, one reason that could be, but talking to so many investors, it is evident that people get into real estate because they've heard somebody mentioning it's a great way to build wealth and they buy it only after a couple of properties, they start realizing, wait a minute, this actually is a business and there's nuance and there's tax strategies and I think a lot of them just come unprepared. They see the opportunity and they see how easy it looks, how
Hmm.
passive it looks. And I think a lot of them just don't do a lot of due diligence ahead of time to even understand again the right proper class or the time commitment it takes and the capital it requires. So some of it is just lack of awareness and lack of expertise. A lot of them don't want to hire somebody like me to sit down and talk through some of the details ahead of time. They kind of like want to come in, get the deal done, and just learn along the way. That's becomes a preference for so many people.
Yeah.
And so it is what it is. And fortunately, when they work with real estate brokers or different advisors, those are a little bit more sophisticated in the tax part of it. They can advise them to connect with somebody like me sooner in the game to learn more, to avoid some of the mistakes and decisions that I made on the tax return, only to find out later. So I've seen some people come from an attorney recommendation or a
Hmm.
real estate broker. Those were like great meetings ahead of time, but that's just not common, not something that I see every day.
Yeah. So we want to hit. There's a couple of topics and strategies, and if we ended up going in a different direction, this is great topic. But we want to talk about depreciation today because huge opportunities there. We want to talk about cost segregation, possibly 1031 exchange. All the things that we're going to touch on today can be a master's class. It can be a 6 month class. But let me ask you first before we really get deep into it. Would you say at a high level, why does the tax code tend to treat real estate differently than normal earned income?
For sure. Well, if you know anything about Congress, nothing gets done for no reason, right? There's a policy need for housing. Every
Hmm.
administration is pushing that. They want home ownership. They want that for many reasons, for affordability reasons. So there's a lot of emphasis on building new units and providing more housing to the population. So the tax code is going to encourage that, and that hasn't changed with changes of administration. That's why depreciation rules are they
Hmm.
tighten up a little bit. The moment they tighten up, they relax again to allow more investments, more money to pour into real estate.
Yeah.
So I think that's just a need for housing is driving the policy decisions, and that drives the tax changes and it gives us all these opportunities to take advantage of it. So I know
So
people call. Go
what
ahead.
I'm hearing you saying is if you want to make your country a better place, then you need to buy more real estate. Am I right?
Spot on. Absolutely. It's a great service to our communities, like all the real estate investors. Yes, you're taking advantage of certain benefits, but you're also creating a benefit to your community. You're providing affordable housing. The more of
Hmm.
it that we invest in and redevelop, the more affordable it becomes. So it's something not to be ignored for sure.
I love that you're touching on that mindset because I feel strongly about that. I know Alberto the same way. Not all of our most profitable deals are the best deals. There's a
Mm.
house that me and Richard Willie flipped years ago. Um, and just driving by that house, once or twice a week and seeing the family that lives there and how beautiful they've made that home, like that's to me, that's worth more than the profit we made off of flipping that house is seeing, because I know the person that lives there, she's raising a family. It's a beautiful thing. So yeah.
Right? Yeah.
And
And
now, and the government
I,
rewards that.
For sure. I went through the same. I had a property that I bought, and it was in a very kind of dumpy area, so to speak. But me lifting up that property elevated the whole like section of the road. The neighbor started fixing his property. The apartment next door fixed the road, so that my capital investment into this little road
Hmm.
section of the community really sparked more development. And so that's what I like seeing as well. Now those things are not just sitting vacant, creating an issue for eyesore, but it's a vibrant part of that community. So I enjoy seeing that as well.
So, so in your opinion, high income earners tend to move toward real estate. What are some reasons you believe that's to be true?
I think number one reason is they're looking to start a business. If you're working for a W-2 job, you may be a high professional, medical, or whatever
Hmm.
field, they're very ambitious people, and they definitely want to get into some business. They see that working for W-2 job is a difficult life to live. You kind of give up your autonomy and freedom. So all of them looking for ways to invest, and investing in a business difficult, requires expertise, a lot of capital, financing is difficult. So starting a really good business is tough. Real
Hmm.
estate, on the other hand, is quite easy. It doesn't require a ton of experience. Lenders are really happy to get you started because collateral is so good, high quality. So they see that as a quick way to get into business, start scaling,
Yeah.
start kind of balancing their income from a W-2 9 to 5 kind of thing to something more passive, but something that could continue on and maybe even outgrow what they've done professionally. So I think that's kind of the easy path to a business ownership, even though it's kind of in the form of real estate.
Yeah. No, that's a beautiful thing. Absolutely. So let's break down depreciation. We could camp out here. So can you give us just an idea for those of us on the call that may not be taking advantage of depreciation, or maybe like how would you explain depreciation to a junior high student if one was on
For
the
sure.
call today?
And you better take advantage of it because if you don't, the IRS will treat it as though you did because it's one of those required elements. If you let it sit on the
Mm,
sidelines, the IRS will act as though you took it and it'll count against you when you sell the property. But that aside, depreciation is a fairly simple concept. To explain it simply is a way to expense the property you buy over time. So most of the time people want to buy something and in their mind the money is spent. It's an expense to them.
right.
Expense, therefore, they're associated with a deduction. But tax code is a little more sophisticated than that. There's a lot of rule of what actually is deductible, even though it's an expense. So buying a home, of course, is a big expense, but it's not a deduction right away necessarily. And so it is a deduction, but in pieces over time. So if you buy a single family residential home, it most likely will be depreciated over 27 and a half years. So you'll take 1/27th of the cost of the property you bought, and you take it 1 year as the
Okay.
business is continuing. So it's just a way to expense it over time, and then that's what we take advantage of to show kind of illustrate how it would kind of work. If you buy a building worth 300,000 right now and you
Hmm.
rent it to a tenant, you will get about $11,000 depreciation expense for the year.
Okay, where
So
does that
even
number
though
come from? So 300K, 11,000 depreciation. That's a
that's
27.
divided 27 and a half years. So that's, and it's a straight line math. So basically, you just take that divided by 27 years, and it is starting in the middle of the month you buy the property. It's not something you get in the
Right.
year one in full, but from the moment you buy, you start depreciating basically annually. So
Hmm.
it's a cost recovery over time that gives you a deduction as you go.
So what steps or what would somebody have to know in order to take advantage of that other than having a an excellent tax advisor on their team?
Yeah, like in general, every asset that's bought for business or for rental service has a life expectancy. So a building like a residential single family home has an expectancy of 27 and a half years.
Hmm.
So you need to know the purpose of the use of the property. Commercial buildings have a longer life, so they're depreciated over a longer period of time. Certain components of buildings could be depreciated quicker, like improvements like fixtures, like
Okay.
flooring, like fixtures and window treatment, things like that. They tend to last shorter time, so you can depreciate it quicker than 27 and a half years. But large building itself and large building components like AC and different remodel projects that are going on, so those are depreciated over that 27 and a half years. So you need to know the use of the property, you need to know the cost of the property. And the cost of the property consists of two elements initially. It'll have a piece that's land cost and
Hmm.
the improvements cost. So we need to know and allocate the initial purchase into these two
Right.
categories, land and improvements. And from there, you just track what other additional improvements are made and you depreciate them as well.
So just a follow-up question, from a newbie's perspective, right? You have this $11,000 in depreciation. How does that get set next to your income that you make for the property? Because is it used to kind of offset that income? So
Hmm.
then, you can then begin to delay these taxes that you might normally have to pay on that.
Absolutely, that's exactly how it works. For a normal, again, single family example, if you're renting a property and of course you're receiving all the rent as income, and then by the time you pay taxes and maybe some repairs and insurance and some of the cost of ownership, by the time you get the bottom line number, it's typically absorbed by that 11,000 depreciation.
Yeah.
So generally, rental would come up with basically income, cash flow into your pocket, but no taxable event. So that's the whole beauty of that.
Yeah.
That's
No,
key.
yeah, that's very well explained. So in essence, when you're buying real estate, keep good records because one thing I heard is the depreciation rate of your real estate is at 27 or 127 and a half or however it's at 11,000 per 3,000. But in addition to that, the improvements depreciate at a faster rate. So if you're not keeping receipts, if you're not keeping itemized items, um, keeping everything logged and keep your books clean. That's for so many reasons that's a critical thing for an investor to do. You may not be able to take advantage of that. An AC is thousands of dollars. A roof is thousands of dollars, and those. And what I hear you saying is that depreciates much faster than the actual building you're purchasing, right?
Yeah, some component. That's what, like you said, record keeping is really critical to make sure you understand what's been improved and when the property was placed in actual rental service. All of it dictates the timing of depreciation, the amounts and elections you can make. Because you can choose. The IRS gives you options. You can accelerate depreciation, you can take a more slower approach. And these are all choices I make with my clients all the time, kind of giving their income composition from other sources, looking at their real estate income, and you can pull these levers. Sometimes you can
Hmm.
accelerate, sometimes you can slow it down, and that's could work for you in the future as well. So there's a lot of levers to pull when it comes to that depreciation, given the good records are there. Because often, if I take over clients who come in without having somebody more knowledgeable in real estate tax, some of these decisions are made on behalf of the client. Some of the improvements are estimated or they're not looked at in any kind of close, scrutinized way. People just estimate, I think so much for this, goes in their tax return. That's all you get to depreciate. But
Right.
once you make commitment and record in your tax return. That's a decision that's a position you took, and IRS will hold you to it. So those records are so critical to put all the values properly, all
Hmm.
the time in the right place, and from there take advantage of all the options you have available in what type of depreciation you will choose.
I
Yeah.
love.
I think, Austin, I think that's a really good segue into like these more advanced tools, right? These
Yeah.
more advanced ways to take advantage of owning real estate. And Andre touched on it, right? He said accelerated, right? Where you can accelerate this depreciation. And typically a new investor, right? Number one, they may not know about depreciation, right? Or the straight line depreciation, which is what we just talked about. But then this more advanced accelerated or bonus depreciation, and he touched on it. And one of the ways, how can we do that? Like, what are some of the tools that we can use to figure out, like, okay, this is going to depreciate at this rate, and this is going to depreciate at this rate? Like, what should investors
Hmm.
go do to get that information?
Absolutely. There's two kind of major method I know you could approach this. One of them is keeping track of improvements you're making since the property is in service.
Hmm.
Knowing what you're spending money on, having a good record can give you that decision. Because if you're buying assets that are shorter term in life expectancy than, real estate itself, you can accelerate those components that are expected to last 20 years or under.
Hmm.
So if, for example, if you bought a house and then from there on, it's in rental service. And then next year, you need to replace the fence. Well, placing that fence as a separate asset could allow you
Hmm.
to depreciate something like bonus depreciation,
Hmm.
because that's a separate class of improvements that would qualify for shorter treatment. And so you have a choice. You can depreciate it over 27 and a half years, or you can make it an election to, you can make it shorter. And so
Hmm.
that decision could really swing your taxable income in a greater direction. So that's kind of an example. Number one, that's like as you go and as you own your property. The second one, you can do it in kind of a grander scale through cost recovery that's quicker. And of course, it'll be cost segregation. And that's something that's people hear probably on different sources. It's a very kind of popular topic. And cost segregation could be a great tool as well. Again, for the right person with the right income composition, it's assessed kind of like property by property. There's a little bit of nuance needed. But in general, what you can do is when you bought a building, whether it's initially at the purchase or sometime in the future, you can break the components into pieces. So you can break your house entire cost into segments. And
Hmm.
a piece of the home, of course, will have a fence and a driveway and fixtures and certain components inside the building that could be depreciated through a shorter period. And so a professional report like that will give you a scorecard of the value of the building and its components and individual pieces. And so those pieces can be taken. So ultimately, what the process involves is taking real property, the full amount, and converting it to non-real property, which is
Hmm.
like personal property, again, like those shorter term components. And what that does is it allows you to take those and create a larger depreciation in year one. Instead of $11,000 depreciation, you may achieve $100,000 depreciation
Mm.
in year. And so, and again, it's because it's such a large amount of expense loaded in one year, it could be a benefit to the proper real estate investor. But there are also rules for passive income that could limit that. So all of those decisions are great options on the table for real estate investors, and that could be really used in the right situation very effectively.
Hmm.
Can you give an example of some of these items that you're talking about that we can depreciate faster than 20? Because you mentioned like an AC, a fence, like that's based on the AC life. What would that be like? 15 years, I'm guessing. Am I thinking about that the right way?
Kind of. The AC is actually going to be one of those larger components. AC does have a provision in the commercial building. There's a possibility to expense like an AC system on the shorter term, but in the residential home, generally it'll be considered long-term improvement. So it'll be
Okay.
just like a house itself. But some of the bigger ones are going to be any flooring that's not permanently attached. So the vinyl flooring that's not glued or not like nailed to the, I guess, foundation, right? So those components, fixtures, chandeliers, blinds. There are a lot of, driveway, any kind of improvements on the outside of the house. So there could be pieces, but generally they fall into this kind of categories. So, like for example, if you buy a new bathtub,
Hmm.
that potentially could become some. It's just there are various components, and the reason it's hard for me to know because it requires an engineered study. It requires a company to come out, inspect your property, because
Okay.
it goes into a lot of nuances. Even certain components, like certain wiring, could qualify if it wires a specific appliance, a specific
Wow.
TV. Even circuits of a wiring system could qualify for sure to use if they're powering a specific device. So it gets real nuanced, and
Yeah.
to really take advantage of all of those components in the accurate way requires a little bit of experience in that kind of work. But there are plenty of vendors out there, and there's some that I work with that will do that and create a huge amount of benefit in year one for you.
That you so you brought up something that I've been curious about. You mentioned a cost segregation study. When can you tell us a little bit what that is and when that actually makes sense to proceed with that option? And if there's a lot, just keep in mind, there's probably a lot of people on the call that may not know what that is. But if you take advantage of it, it can make you a lot of money.
For sure. In general, it works very easily and very quickly if you own multiple properties that are really profitable and you want to offset that profit
Hmm.
quickly. So if you have seven properties, five properties, and they're performing really well, you can create a cost segregation study on one of them and escalate all the depreciation on one and offset the income from all other properties. So ultimately, bottom line, you need passive income that's positive to offset the loss you will create on one property that will become passive loss. With real estate investing, because it's such a passive activity, generally speaking, passive losses cannot be taken against other income like W-2
Hmm.
income. You need other passive income to absorb that big loss you create. So if you're in that situation, if you have a shopping center that's creating a lot of income and you have some residential property that you can take advantage of cost segregation, that great loss could offset your other passive income.
Mm.
That's like the direct application. Or of course, if you're a real estate professional, it's a special status IRS allows, then the loss could allow you to accept, and kind of use up against other income like W-2. But for a general, high net worth individual with a great job and passive rentals on the side, the
Hmm.
one thing really watching for is passive losses to be too excessive. That's why just taking a cost segregation study and creating this large expense will end up just creating a passive loss that's most of the time will sit there unused until future passive income is generated. So it still creates value, but it'll be over time. It'll go into this piggy
Yeah.
bank and it'll be for future use. That's why, but it requires cost, it requires a more aggressive position to be taken on the tax return. But the beauty of this, you can do a cost segregation study and not apply it right away. You can be patient and wait for the right moment, and you can make a change in accounting principle down the road, attach a form, and update your depreciation in the future time. So it's really customizable, like when you want that benefit. You can just get it all done, kind of be ready to pull that trigger when you're ready.
Add that to your word wall. Cost segregation study, bonus depreciation, straight line depreciation. What else you got, Albert?
Oh man, I got a lot, man. Well, you know what I want to talk about because there's been some recent changes here with this new administration is the 1031 exchange.
Hmm.
I think that's another advanced tool that a lot of investors, including myself, just overlook. I've done it in the past, right? When you're selling a property and being able to kind of take the proceeds from that property, not necessarily tax free, right? Because a lot of times all we're doing is just kind of kicking that tax can down the road,
Yeah.
right? I mean, eventually we'll have to pay the tax, or there may be some other things like, with trusts and things like that, without getting all into that, where we can then bypass those, whenever we, bequeath our properties to our heirs, right? But
Correct.
1031 exchanges have been in the news recently with kind of the amount that you could. Am I right? I think I might be getting that mixed up, maybe with cost segregation. I am. Never mind. Scratch that. Talk to us about 1031 exchange. You're the expert. Go for it.
Like you mentioned, you did say that with depreciation, it is a kicking the can down the road, and it's truly what it is because depreciation is not a permanent tax avoidance. It's a strategic tax deferral, which
Mm,
again, it could end up deferring tax, and then you can take advantage of that in the future in different
Hmm.
ways. But with 1031, it's a mechanism of rolling the gain that you have in a property when you sell it to another property. So ultimately, you're not taking possession of the proceeds of the sale and you apply the gain to the next property. By doing that, you're rolling the tax bill down the road. And then, of course, like people probably have heard that you can roll these gains into other properties. And again, but like you mentioned, if you pass on and you leave these properties to your heirs, at that time the gain is totally eliminated. So that's like the most effective way to pass on properties and erase all the gains that you've deferred for so many years. So 1031 it is the mechanism that takes that. It requires a qualified intermediary
Hmm.
to facilitate that. And there are timings involved because you don't get to just sell the property and then 3 years down the road do something else and then all of a sudden you can
Yeah.
apply it. There's specific timelines. When before you sell the property, you need to identify where the money is going to be going, so that needs to be a little bit of homework done ahead of time, and it needs to be done in writing. So it's something that you have to commit to pursue. And then by the time you sell the property, you also have a timeline. You have 180 days to actually complete the purchase of the next property. So
Hmm.
there's time involved, there's
Is that to
planning.
complete the purchase or go under contract?
You have to complete the purchase.
Okay. Is
So
it possible if I'm on day 179, I sold the property January 1st and now I'm at the 6th month. Is it possible to have that deadline extended, or is it like I got to close that day, or I have to pay all those taxes?
generally, yes, like it's a time bound kind of thing. Like once you identify the property, you have to complete the process. That's
Hmm.
like with deferral. So that's why it's something that needs to be done kind of on a tighter deadline. That's why property has to be kind of in line already. All these ducks have to be in a row. You can lose that benefit.
Yeah.
Mm.
You
And
can.
of course there's some sophistication now. You can do a reverse exchange as well. There are different other mechanisms that
Uh-oh, he's getting crazy on us now with the reverse exchange.
That's
but
for REI 201.
That's like REI after dark right there, man.
After dark.
that's right. And again, all of these strategies that could be evaluated kind of like together for a taxpayer because not everybody needs to roll it over. Maybe it's
Yeah.
a great harvest, some of the losses and offset with some of the gains. And or when you sell the property, if you had passive losses we discussed earlier and they're suspended sitting there unused, well, that could be unlocked when you sell the property. So it's sometimes deferral could be a great tool, but of course it requires some money output, requires a professional to handle that exchange. So that cost is also needs to be considered. And sometimes just, again, could be a preference to just realize these gains, especially if time is right and you're in lower capital gain bracket. Maybe that's a point of planning there. So it's a tool like any others, and it could
Hmm.
be about
Couple of
one.
questions with 1031. Can I sell my house and use a 1031 to use the house that I live in to buy real estate? First question.
Personal property will not qualify for an exchange. It has to be like a property in service already.
But you're already getting tax-free profit
Yes,
at certain levels anyway, right?
yes, when you sell your house, you'll be excluded if you qualify. Again, there's some qualifications for
Okay.
exclusion of household. But for a married couple, it's a very large amount. Like right now, it's 250 per person, basically. So 500 for a married couple
Right.
could be excluded if you've lived in your home for 2 out of the 5 years. So it's a great benefit right there when you get rid of your property, collect all that tax free, and you can reapply it into a rental.
Hmm.
Yeah, I don't think a lot of people realize how much they're saving when they do that. What about asset types? If I do a 1031 from my fourplex, can I buy an industrial building or strip center?
Absolutely. It has to be like property. So it has to be like real estate with real estate. You cannot say real estate by equipment, but you can do real estate for real estate, could be different classes, could be single family, could be commercial, could be land. It just has to be real property.
What if I'm changing entities, like taking it from my personal to either a trust or an LLC, or within a partnership or from a partnership? Does it work that way? Like if Albert and I, have an apartment complex and then we want to sell it and go our separate ways, can we still take advantage of that 1031 exchange?
It could. We just need to kind of talk a little bit offline on some of those mechanics and specifics. but there's some planning involved as well, like in that, because it's especially certain entity types, and if we need to touch on some of the entity choices when it comes to real estate, it's a very big topic of its own,
Mhm.
where that is really interesting how it applies to different types of businesses. So there's some other considerations when it comes to tax on the entity level itself. So yes, there's some planning needed for that.
Well, and that's why the whole month of February is dedicated to tax strategy and business setup. We're gonna continue this discussion about tax favored asset class. You brought up entity structured. We have an attorney joining us next week for that. Andre, you're coming back before the month's over because we're gonna go deeper into tax strategies and bookkeeping and CPA. So this is a incredible content, incredible month. Albert, did you want to talk about reps, real estate professional status?
Yeah, so that was something, when I first met Andre, like I tried to, not necessarily tried, but I kind of figured, oh, I know some things that he might not know. And I would talk to him about, the real estate professional status and like the STR loophole, like all of these things that I would hear on a podcast. And Andre's like, oh yeah, it's this. And he would explain it to me. But what like for that real estate professional status, like who is that really designed for? And more too, like who is it not designed for? Like who's not going to benefit from that?
The real estate professional status is a great tool as well. But again, like any IRS tools, they give you the option, and there are a lot of strings attached, and they
Mhm.
really hold you to be consistently carrying out the strategy you selected. But in general, real estate professional status requires two major things. One of them, you cannot have another job that occupies more than half of your time. So it's going to be out for most people who have a W-2 job. You will not be able to defend that you have a W-2 full-time job and real estate is more than half of your spent time in activities. So that test alone weeds out a lot of people. So it is really well designed for people who truly on real estate business kind of activities, property developer, home builders, redevelopers, anybody connected to any kind of real trade, leasing businesses, things like that. So if you're in one of those businesses, what real estate professional status could do is could unlock so the losses you create in real estate could become active for you. So that's the huge advantage. And the advantage comes in is let's say you have a spouse who's working and has a great income and you create a lot of losses on the real estate side. Without this real estate professional status, losses could be passive.
Mhm.
And so it would be accumulating because you cannot use them while your spouse has a lot of income. And so could unlock a huge opportunity to reduce spouse's income, or possibly if you have other income, that could be kind of in play as well. So but of course, the second test is going to be the time involved. So you also have to not only be in the real business, most of your time ultimately, you also have to prove property by property that you spend material participation hours in each property that's you're
Mhm.
wanting to use the passive income on. And that becomes a little challenging. So what you could do is you can make an election to combine all properties into one activity. That again, it's a little more advanced strategy because then you're committing yourself to treat all of your real estate as one business in essence. And so that also could limit you if you sell one property but not all, then you would be considered not disposing of all of your business. So there will be some implication of passive losses as well. So, but it works really well for somebody who is a property investor, developer, redeveloper, or maybe somebody who's maybe a spouse is doing that full time and you have a W-2 job. And so one of the spouses can qualify, and in the joint tax return, both kind of get the benefit of that real estate professional treatment. And so it's a huge strategy. But again, it's not necessarily needed unless you have losses from real estate. If you're
Mhm.
operating profitably and every property or majority of your properties are creating a lot of net income and
Mhm.
some are losing money through different depreciation methods we discussed, and the net of all properties is positive, you may not need to worry as much about any of these advanced strategies because the goal is to just make money from real estate. And if you're making money, some of the more
Yeah.
complicated things that you need to attest to on the tax return are kind of on the sidelines,
Yeah. It
But
doesn't
when you
apply.
correct, when you start accelerating depreciation, you're strategically taking losses on some properties and you have net loss for the year, that's where a lot of those tools come out and you're trying to basically create a structure that allows you to take advantage of some of that timing, of some of the decisions you're making.
Can you talk to us just for a minute about entity structures? What do you recommend as far as, should I have an LLC on each property? Should I have one LLC, series LLC, S corp, C corp partnerships?
As you mentioned, it's definitely when you start talking about entities, it kind of goes into the area of legal kind of strategic thinking as well, because the LLCs and all of these entities, it's a matter of state law and could be very specific state to state, and what interest you're really pursuing. Because it, any choice you make regarding the LLC could have no may have no impact on the tax side as well. So even if you set up an LLC and you own it by yourself individually, it'll bypass the LLC. Income is still going to be reported in your personal name. So LLC and certain to a certain extent kind of company formation process is more for legal liability reasons
Hmm.
first. Then, if you have partners in the deals, if you have a certain specific reason to do it in a way that would guide you to a different form of business, like a partnership or maybe a corporation, there's specific reason on the tax side you can consider. But
Hmm.
first question, how do you avoid legal liability? And that's where,
Right.
proper designing your structure holdings, whether it's serious LLC or just an LLC for each property or for some properties, could protect you in case there's any kind of injury or any kind of legal matter that could arise as a result of your rental property holdings. But tax is, again, a little bit disconnected from that, but not always. Because, in general, what I see is most real estate investors' passive holdings would be in the form of an LLC for that big liability reason. But second, because it's easy for tax purposes. LLC, if it's owned, let's say in Texas, we're a community property state, if it's owned by husband and wife, you
Hmm.
can make not to treat it as a partnership. So even in a joint ownership between married couple could become just a sole proprietorship type of income, very simple. So it really reduces the need to file complicated partnership tax returns and reduces that administrative and financial burden on property owner. And and another the big reason why it's really important to understand what entity you're setting up,
Hmm.
because appreciating assets like real property that will continue to go up in value. If you put it in a corporate structure like an S corporation, for example, which I have some people that I've seen have done, if your S corporation status, if you company is terminated, or if you accidentally deed the property over out of your S corporation, you will create a taxable event,
Mm.
because that could be basically a liquidation of your property at fair market value without you actually selling it. So you may be facing a tax bill while you're still holding the property in your hands. So it's really important to know that LLC partnerships, all of those are more friendly to that. If the property is appreciating, you have the ability to move it out of that LLC to, again, for various reasons, people do that. But if you do that, it'll allow you to transfer it at cost value, not at fair market value. But some entities could force you to create this liquidation event, and that could be really dangerous. So
Wow.
that's
Yeah, avoid that.
say, talk to somebody about the legal aspect of it. Talk about the nature of your business. If you're flipping properties, it could be kind of the opposite. Flipping properties should be more an operating entity, maybe like an S corporation, possibly, because you're going to be creating ordinary income. But
Hmm.
passive things like rentals would be more in a non-active income bucket, kind of like maybe LLC individually owned, but or maybe like a partnership. So there's kind of a rules of thumbs, but again, it's a lot of nuance need to be considered before you kind of go down that path. But what I often see, I'll tell you that from experience, is people go to LegalZoom, they create a property, they make all these elections, and then they place property into it because the lender says, hey, we need this property to be held in this name.
Hmm.
And they just go to the county clerk, they transfer the property from their company over to another holding company or to their individual name, and they constantly move assets from and to different LLCs. That could be a nightmare
Yeah.
if examined, because all of those events could become, or some of those events could become taxable without you realizing it. So there's
Ah,
a something to be said about planning, long-term vision, and understanding where your holdings are going, and then you structure your holdings accordingly, and then you can eliminate a lot of these troubles.
beautiful.
Awesome.
That's very helpful.
Yeah.
Yep.
I'm gonna have to go back and re-listen to this episode again.
It's so good. I told you, Austin, it's so good. So we're kind of running up against time. I want to make sure, number one, we get Andre's contact information here in just a minute. But really, at the end of this, what is one thing, Andre, that just one thing that you hope investors will remember from the call
Hmm.
today? Like, what should that be?
I think what they need to know is real estate is a business and it's an easy business to get into for anybody. And you can start slow, you can experience, you can see where you're good at, see what you enjoy about it, and kind of you can scale from there. So it's something that we're quite familiar with because we own properties if we own a home, so we understand kind of the mechanics of it, learning and practice how to handle it, how to deal with tenants, how to improve and fix it and price it. Once you
Hmm.
have that experience, I think you'll realize like how scalable that is and how easy to keep going. And if it is for you, you'll learn it very quickly and it'll just allow you to just scale quick. And so that's what I would say. Take advantage of all the tools that are available, and there are a lot of them, and find somebody who can guide you along the way if you don't know it yourself. Do a little bit of planning, don't ignore it, keep great records, and just go and build an empire. That's just the way I think successful people do it. And that's what I'm attempting to do, and I will continue to do it, and I'll help some people along the way.
Awesome. Awesome.
Andre,
Well,
tell us exactly what a partnership with you looks like. What services are you offering, and how do we get in touch with you right away?
Perfect. I Most of my engagement with real estate investors, property developers, falls into a couple of different categories. Some are a little bit more self-managing it. They need a little bit of advice and practical kind of hand-holding, and so that works as a kind of a small-scale commitment on my part, where I am there to support them as they need it. And so we have an engagement that we set up, kind of a again low budget option where
Hmm.
they have access to a professional that we can set up a meeting and I'm guiding them and I'm giving them coaching. So I do a lot of coaching. That's like kind of a step one where I engage. And if they get busy and they need more work, they could scale up and they can outsource more of their actual bookkeeping to me. So I have another option where I can handle their bookkeeping. It's a little bit more involved in my part. And then there's more of a kind of a robust advisory where we can meet more often. We can talk about upcoming deals and what kind of income or loss you're anticipating. How can we net that? So it's more of a dynamic kind of relationship in the course of the year, looking at what is coming up, what do we need to be aware of, as opposed to just finishing the year, having a box of receipts, and then learning what's happened, and then it's kind
Hmm.
of too late for tax planning. So I'm trying to be more in the advisory side of it. But of course, I do full tax compliance, tax return filings for rental properties. But I would just say half and half. It's kind of like this advisory, helping people understand their books, teaching them QuickBooks or accounting tools like that, so they can be better property owners to understand what goes into their tax. More of an education piece is a big part of what I believe in and what I offer. But those who are a little bit more busy or maybe don't not interested in that, I definitely can take more in the active managing role as well. So I can engage kind of from kind of low engagement level to higher as the needs are and as they develop. So it's very easy to start with me just to kind of start learning and start becoming a better property owner. And
Perfect.
and then so really the first step would be just to reach out to you and like kind of start with like a discovery call. So how can they reach you?
Yeah, you can reach me on my website, atlastax.net, and my email is Andrey, Andrey at atlastax.net. It's a great place to start. Set up a meeting. We can definitely do a little exploration, your current setup, your current holdings. What are some challenges? What are some things on the table that you can consider as levers? And then we'll go from there. We'll pick the pace that works for you specifically, and we'll make it happen.
Love it.
Beautiful. We'll definitely leave that in the show notes. Andre, thank you so much for
Man,
joining us. Don't forget to subscribe. This is live broadcasted on Facebook or on YouTube, Apple, Spotify. Subscribe, like, hit the notification bell, write a comment, share with a friend. Join us next week. The Zoom link's on Facebook, or shoot me a text. Hey, we're looking forward to having you back at the end of the month as we
No
wrap up our
problem.
tax series.
thanks,
Thank you
Andre.
guys for
Thanks,
inviting me. I
Andre.
enjoyed it.
All right, Albert, great episode today, brother.
All right, awesome, man. We'll see you next time.
All right. Have a great week. Bye.